That's not correct. This is February 3rd, 2022. Welcome to the Senate Hybrid Tax Committee. We've offered many types of committee meetings over the last few, almost 3 years now. This is the first one that is actually a hybrid meeting. That means that we have members here at the table. We may have members appearing here in G15 of the Capitol as well. And of course, we have testimony and testimony via Zoom. So welcome, members, to this first hybrid committee hearing. And I want to welcome you all back to the Tax Committee. It's been quite a year and quite an interim, actually. Might not have even felt like an interim. We were so busy doing important things for our state. And also, I want to just welcome all of the members. And I'm going to take just a minute to allow each member to introduce themselves and tell briefly the communities that they serve. And we're going to start with one of our new members, Senator Coleman. Senator Julia Coleman is the vice chair. Welcome. And if you want to just say a couple words about yourself and your district.
Absolutely. My name is Senator Julia Coleman. I represent Senate District 47, which includes all of Carver County with the exception of a few precincts of Chanhassen. And a fun fact, used to be Senator Nelson's intern. So really happy to be serving as vice chair here.
Yeah. This is a great thing to see. So we're thrilled to have you here, Senator Coleman. And our subcommittee chair.
Well, thank you, Madam. Thank you, Madam Chair. Senator Bill Weber here from Senate District 22. My district covers the very southwest corner of Minnesota. I represent all or parts of 9 counties, Rock, Nobles, the west half of Jackson, Pipestone, Murray, Cottonwood, Lincoln, the southern 2 tiers of townships of Lyon, and 3 townships in southwest Redwood. And so pleased to be here. This is my second year in the tax committee work, and this is my 10th session overall. Thank you very much.
Thank you, Senator Weber. And Senator Weber is the committee chair for the subcommittee on property taxes. So as you'll hear today, bills that have been referred, all the tax bills are referred to the tax committee, and then we'll be sending some of those down for Senator Weber's further work. So you'll hear that as well. Senator Chamberlain. Just going down the line there.
Good morning, Senator Chamberlain, represent Lino Lakes, District 38. Always happy to be back in G15. Thank you. Good morning, all.
Thank you. Senator Klein.
Thank you, Chair Nelson. I'm Senator Matt Klein, representing the communities of Mendota Heights, Inver Grove Heights, South St. Paul, and West St. Paul, 1 precinct in Eagan, and several small cities. And I am the DFL lead on the property tax subcommittee.
Thank you, Senator Klein. And we have members who are Zooming in today as well. I don't have the ability to see them or their hands, but I'm going to start with our lead, Senator Rest. I'm sure you're on today. Could you just say a couple words about your committee, about your communities that you represent?
Thank you, Madam Chair. I'm Ann Rest, Senator from New Hope. And my district includes Crystal, New Hope, Robbinsdale, the northern half of Golden Valley, and the east side of Plymouth.
Thank you, Senator Rest. I can see you there on my screen now. Thanks. Thank you so much. We also have another new member to the Tax Committee, not totally new, but a returning member to the Tax Committee, and that would be Senator Gazelka. If you could speak a bit about your district and your interests.
Yeah, Madam Chair, good to be on the committee again. I served quite a few years earlier, and then when I became leader, I went off the committee, but it's really good to be back on. This is an area that we have a lot of opportunity to provide relief for people in Minnesota, and excited to be on it. I represent Senate District 9, Central Minnesota, so Morrison, Cass, Wadena, and Todd counties, and looking forward to working with you.
Thank you, Senator Gazelka. Welcome back to the Tax Committee. I'm glad to be back in the Tax Committee as well. All right, and now I've not been able to see, I think I see Senator Dietzick on Zoom. Senator Dietzick?
Hello. Hello, Madam Chair. Hi, everybody. My name is Sen Dietzick, and I have the honor and privilege to represent the eastern portion of Minneapolis. So I have northeast Minneapolis, southeast Minneapolis. Then across the river, I have both the east and west bank campuses of the University Minnesota Minneapolis campus, Augsburg College, Cedar Riverside neighborhood, and then the northern half of Seward. And excited to be starting this year with the tax committee.
Yes, thank you, Senator Dietzick. Senator Bach is also a longtime tax committee member. Are you, I don't see if Senator Bach is here.
Don't see him.
All right. And then I think it's important that members and the public know about the staff that we have that is helping as we wade through complex, often tax committee issues. So I'm going to ask my staff to introduce themselves. I'm going to start with my committee administrator, Mr. Steinhoff.
Yeah, hello, members. Madam Chair, my name is Brian Steinhoff. I'm the committee administrator for the Senate Tax Committee and Senate Property Tax Committee. Looking forward to a good year.
Thank you. And my legislative assistant?
Use your microphone. Hi, members. My name is Madeline Hoy. I am the committee legislative assistant for Taxes Committee.
And then we have our researcher, Mr. Mickelberg.
Oh, thank you. Thank you, Madam. Thank you, Madam Chair.
Dan Mickelberg, Republican Research Staff. Thank you.
Thank you, Mr. Mickelberg. And we have Ms. Broughton.
Hi, I'm Krista Broughton, DFL researcher for the Tax Committee.
Thank you, Ms. Broughton. And now our nonpartisan staff, we have quite a team. We'll start with our Senate Counsel, Ms. Pollack.
Good morning, Madam Chair and members. I'm Nora Pollack. I handle income and sales tax issues.
Thank you. And then Mr. Silvia.
Good morning, Madam Chair, members. My name is Eric Silvia. I was on a council and I primarily handle property tax issues.
Wonderful. And let's see, Mr. Willems.
Hi, good morning, everyone. My name is Jay Willems, and I'm the Senate Fiscal Analyst for the committee.
Mr. Arneson.
Morning, Madam Chair and members. My name is Bjorn Arneson, Legislative Analyst for the committee. Primarily handle local government aids, county program aids and other aids, and property tax modeling work. Thank you.
Thank you so much. As you can see, we have a very strong committee of members and staff as well, so we get the best information going forward. We have and my name is Senator Nelson. I'm thrilled to be the chair of the tax committee. This is my second year in this position. Previous chair of the Education, Finance, and Policy Committee. I serve in Olmsted County, Rochester, Chatfield, Dover, Yoda, Stewartville, 14 townships. And this is my, I believe it's my 14th year in the legislature. That includes a little bit of House experience there. And of course, our pages who help run our meetings so smoothly. Kaylee, are you online or are you here perhaps? I think I saw you setting up today. Okay, Kaylee, if you could just, Callie, all right, say hello. Just tell us where you're from, Callie.
Hi, I'm from Belton, Minnesota, which is 40 miles northeast of Fargo-Moorhead area, and I'm happy to be here.
Thank you for helping us get started, particularly on our first hybrid hearing. And then Anna.
Anna, yes, I'm Anna. I'm from Minneapolis. I'm also happy to be here.
Thank you so much. Great to have you all here. And of course, we have a full deck of presentations today as we move forward into this non-budget year, but a non-budget year that has historic projected and some surpluses already, and we're going to hear about that today. Before we call our first presentation, I do want to just note those two bills. There's two property tax bills that we're going to be sending to Senator Weber's Property Tax Subcommittee. That would be Senate File 2680 and 2681, just so the public can follow the progress, the trajectory of those bills. So those will be in Senator Weber's subcommittee on taxes, or on property taxes. All right, today we're going to have a presentation from MMB giving us an economic forecast, looking at what should we be expecting. We've seen a lot of changes, certainly lived in historic times here in many ways, including all the changes in the forecast and our state's budget. And with that, I'd like to welcome our first presenter, who is Commissioner Showalter, MMB Commissioner. Mr. Showalter. Commissioner Showalter.
Thank you, Madam Chair. I appreciate the opportunity to testify today. For the record, my name is Jim Showalter, Commissioner of Minnesota Management and Budget, and with me is Dr. Cullen Bakitas, our state economist, and Anna Mengi, our state budget director. And I think this is Anna's first appearance before the tax committee in the role as assistant commissioner and state budget director, and happy to have her in that role. We've got a deck that is from the November forecast, and we'll take you through it. And it is, as you say, a significant restate and refresh of where we see the state's economy. It's based upon the U.S. economic data from our consultants, IHS Markit. There have been a couple of monthly updates since then, and we can probably get into that in our conversation and presentation. But it really is the Minnesota forecast based upon the national economy and how we see Minnesota's economy and revenues responding to that. Dr. Cullen Bakitas will be talking about that extensively in these slides. And we'll also wrap up sort of in where we are in the budget situation. I just want to also note, Madam Chair, there's always been some confusion, especially in this last year, about what's the state forecast and what's the status of federal funds. I just want to point out that, for purposes of this presentation, we're really talking about the state's own revenues and expenditures. And so the remaining money in the ARP or ARPA fund is not part of this conversation. We're really talking here about our tax revenues and what we see coming in the forward. Happy to take questions, Madam Chair, during the conversation or afterwards. And obviously all of this information is on our website as you wish. Let's just go to the next slide. This just gives you a thumbnail sketch of what we're going to be talking about. Obviously, the forecast is significantly improved from previous estimates. We anticipate a $7.7 billion surplus during the current biennium of 22 and 23. This is really driven by strong income and consumer spending, strong profits driving the corporate revenue, and ultimately we were seeing a lot of that activity even before the end of the fiscal year on July 1 of 21. And so what's happening is we're seeing almost $3 billion of estimated improvement in our revenue picture coming into this forecast. So a significant amount of this money is already money in the bank, essentially. What is curious is that, how far we've come over the last year and a half. You'll remember just a couple of years ago, we were wondering whether the budget reserve would be enough to get us through the biennium that just concluded. At this point, we have not only had enough to get through the past biennium, but the budget reserve has been restored and now stands at about $2.656 billion. The outlook does carry some balances into the 24 and 25 biennium, and the state budget director will talk about that at some point. And all of that said, we've been surprised before. We know that the last couple of years have had lots of twists and turns, and we'll mention and discuss some of the risks and uncertainties going into this forecast. The next slide just gives you a sketch of where we're at right now. As I mentioned in the overview, we had some estimated money at the end of the regular session, at the end of the special session. About $127 million showed up on the spreadsheets. What wasn't accounted for at that point was that the monthly revenues were coming in substantially higher than previously expected. We know that about $3.1 billion of the $7.7 billion is essentially rollover from fiscal 21. And the remainder of the improvement is forecast gain over the course of the biennium. Subtracting from that amount are statutory allocations, because this is a current law forecast, statutory allocations of revenues to the stadium reserve because of the source of those revenues, and allocations to the budget reserve because we had an allocation basically triggered by the improvement in the forecast, leaving us with the $7.7 billion figure. The next slide then gets you into just sort of the numbers. What you'll see here again is the end of session numbers and where we stand at the November forecast. Most all of this story is based on improvements in revenues. The beginning balance is obviously improved, as I mentioned, from earlier revenues coming in the months of May, June, July, and August. But beyond that, once we get into this fiscal year with August going on beyond, we have still an improvement of $5.1 billion in our revenues picture. Spending is improved or went down a little bit, so it improved the number slightly, but not considerably, getting us to that bottom line of $7.7 billion. That kind of is the key set of overviews. What we're going to do is talk through the economy and that revenue picture, which really drives this forecast. So I'm going to turn it over to Dr. Kolombakidis to walk through the economy and those revenue changes, Madam Chair.
Dr. Kolombakidis, welcome to the Tax Committee again, and please introduce yourself for the record.
Great. Thank you for having me, Madam Chair, members of the committee. For the record, I'm Laura Kolombakidis, Minnesota State economist. And thank you, Commissioner Showalter. I'm going to start with the U.S. outlook and how it has changed since February. So I'm looking at the difference between our February of 21 forecast and our November of 21 forecast. Then I'll move to Minnesota's economy, and then I'll turn to details of our November revenue forecast. So in the first chart, we're showing the level of U.S. real GDP, so both the history and the November forecast for 21 through 25 by our consulting firm IHS. In the history, you can see the decline in GDP that occurred during the recession of 08-09, and then the 10 years of steady economic expansion that followed. And then you can see the abrupt two-quarter contraction that was triggered by the COVID-19 pandemic in the spring of 2020. You can also see the sharp bounce back in the second half of 2020, so that sharp 2 quarters down and then a bounce back up in the second half of 2020, and then the steady growth that is expected to follow. Unexpectedly strong economic growth in 2020 and in 2021 have driven tax revenue gains at the federal level and in many states, including, as you heard from Commissioner Showalter, here in Minnesota. As the U.S. economy continues to recover from the 2020 recession, personal income, home values, financial asset values, and corporate profits have all risen. The U.S. unemployment rate fell in October of 21 to a seasonally adjusted 4.6%. Since then, that has fallen further to 3.9% as of December. And that 4.6% in October, that was the lowest since March of 2020. Total U.S. employment was at 97% of what it was before the pandemic. In November, IHS expected employment to recover to its full pre-pandemic level in the middle of 22. And as of their January forecast, that's roughly the same, a little bit toward the end of this year instead of in the middle. Some important economic variables have exhibited stronger growth than expected in 21, so last year. The November IHS forecast for employment and for real inflation-adjusted consumer spending are higher than in their February 21 outlook. In addition, forecasts for nominal consumer spending, wage and salary income, corporate profits, these are all variables that include the effects of inflation and influence tax revenues. Those are also higher than in February. IHS, as of November, was forecasting U.S. real GDP to increase by a robust 5.5% in 21, and then decelerate to 4.3% in 22. As of their January outlook, so as the commissioner said, I'll sprinkle in some of the updates since their November outlook. So as of their January outlook, they now are expecting 5.7% in 21. So that's an increase for 21 and 4.1% in 22. So that's a decrease in the growth rate for 22 for this year. Growth in this year is expected to be supported by a declining rate of COVID infections easing of supply chain blockages, and increased labor force participation. Real GDP growth in their November outlook was expected to average 2.7% in 23 through 25. So basically the difference between their November outlook and their January outlook is this, is that in their January outlook, they've increased the growth rate for 21 and decreased it for 22 slightly. And that is largely because of an inventory pull forward from 22 into the end of 21. So there was higher inventory growth in 21, and that came out of growth in 22. And then the remaining years of the forecast, 23 through 25, those have growth rates that are lower than what we had in November. The reasons for that are that their forecast, because of capacity constraints. One of those capacity constraints is that they have a lower forecast for the U.S. labor force participation rate in their January outlook than they did in their November outlook. Two other important changes in their January outlook from November are that they have higher inflation forecast, and they have an earlier increase in interest rates by the Federal Reserve. So their liftoff of the federal funds rate comes earlier than what they had in November. All that aside or digested, the U.S. outlook remains uncertain. Obviously, things are still changing month to month and depends on the path of the pandemic and on responses of households, businesses, and governments to the changing public health landscape. In the November forecast, IHS assumed that the rate of COVID-19 infections would continue to recede. Note that the November forecast for IHS was released before we all knew about the Omicron surge. A lot has happened in a couple of months. As of November, though, they were expecting U.S. society to move toward managing the risks of coexisting with the virus for an extended period. And that's the way they're talking about it in their January outlook. They're saying that we are moving from pandemic to endemic, and they expect U.S. consumers and businesses to manage the risks of the virus. The November IHS forecast reflected the impact of the Infrastructure Investment and Jobs Act, which was signed into law on November 15th. And in November, IHS had not put in any impacts of the Build Back Better bill, the reconciliation bill, because its size, scope, and timing remained too uncertain to include in their forecast. They have obviously not included it in their January forecast either because it didn't pass. So the fact that the Build Back Better bill did not pass does not have an impact on the IHS forecast. I'll now walk through a few examples of changes to U.S. variables that impact Minnesota's tax revenue forecast. So in the next chart, we show levels of U.S. spending on durable goods other than autos and medical devices. Most of these things are taxable under Minnesota's sales tax. The solid line shows IHS's November outlook, and the dashed line shows what they expected in February. During the pandemic, consumers shifted their spending from personal services and activities like entertainment, dining, and travel to goods. And this shift caused goods spending to substantially exceed its pre-pandemic peak, and it remains at elevated levels. Spending on durable goods, as shown in this chart, is expected to grow 23% last year, is expected to have grown 23% last year. That's more than double the rate that was forecast in February. Following years of low inflation, the next chart we addressed that inflation. So following years of low inflation, price levels have become more salient in this forecast, so as of the November forecast. In this chart, the height of the bars shows annual growth in the consumer price index. The blue bars show the history and IHS's November outlook, and the gray bars show their February forecast, February of 21. IHS raised their forecast of CPI inflation in 21 to 4.5% from 2.1% in the February outlook, so a really big change there. For 22, IHS in November expected 3.3% inflation compared to 2.1% in February. These forecast changes for 21 and 22 are due to two main developments over the course of 21, so between February and November. First, energy prices, including oil prices, toward the end of the year were substantially higher than expected in February, and those prices were expected to remain elevated in the near term. Second, that high demand for durable goods that I mentioned, along with issues related to the global supply chain, have caused a surge in durable goods prices. In their January outlook, IHS raised expectations for CPI inflation to 4.7% in 21 and 4.2% in 22, but it settles to 2.2% in 23. IHS does the reason for this settling out to to the low twos going forward is that IHS expects the gradual resolution of supply chain issues and rising U.S. labor force participation to slow inflation. They forecast CPI inflation, again, to settle near 2% annually by the end of, into 23. In their November outlook, so related to the inflation story, in their November outlook, IHS expected the Federal Reserve to begin taking action to raise the federal funds interest rate in March of 23. So next year. In their January outlook, they've moved that assumption all the way to May of 22. So a significant difference in when they expect interest rates to be increased by the Fed. In the next chart, the height of the bars shows annual growth in U.S. total wage and salary income. So to be clear, total wage and salary income is the sum of all the payrolls of all the employers in the United States. And the height of the bars shows the growth rate in that variable. So this number can grow if we have more people working, or if we have the same number of people working and average wages per worker have gone up. So it's not an increase in the average wage alone, it's more people working and or people are making more money. In this, so the wage and salary income grew. So if you look back to 2020 in this chart, note that wage and salary income grew 1.3%, even as unemployment peaked last spring. U.S. unemployment peaked in the spring of 20 at nearly 15%. For wage income to grow at the same time that so many jobs were lost illustrates the unevenness of the employment and income losses of 2020, when low-wage workers were much more likely to lose jobs than high-wage workers. The last 2 years have seen a decline in U.S. labor force participation as workers have opted out of employment for a variety of reasons, including COVID-related safety concerns, early retirement, and trading employment for starting a business. In December of 21, the U.S. labor force participation rate was 61.9%, well below the 63.4% prior to the onset of the pandemic. IHS does expect a tightening U.S. labor market, meaning low unemployment and high demand for workers, to drive up wage and salary income. As of their November forecast, they expect strong wage income growth of 8% in last year, up from 6.7% in their February outlook. That's followed by only a small deceleration to 7.9% this year. The forecast for wage and salary income has been revised upward significantly for 22 through 25 compared to February. In January, the outlook has been increased. The outlook for wage and salary income growth has been increased to 9% in 21 and 8.2% in 22. And then it's down to 5.3, it's been lowered to 5.3% in 23. So from 23 through 25, the forecast for wage and salary income growth is down a couple of tenths from November, but it's still above what it was in February. That's clear. The next chart shows levels of U.S. corporate profits. This is the main factor that determines Minnesota's corporate tax revenues. The solid line shows IHS's November outlook, and the dashed line shows what they expected in February. Corporate profits were unexpectedly strong during the first half of 21, driving higher than expected corporate tax receipts last year, and an increase in the corporate profits forecast. So it both increased our revenues and it increased our forecast going forward. In this outlook, in the November outlook, corporate profits are expected to grow 19% in 21, nearly 4 times the rate forecast in February. So another big change, in addition to the consumer spending numbers that I showed you, big change from February to November. Moving to Minnesota's labor market, this chart shows, so the next chart is the unemployment rate. Thank you. Moving to this chart shows the official unemployment rates for Minnesota in the dark line and for the United States in the light line. The vertical gray bars show the US recessions, so the white space between the bars show the US expansion and recovery periods. You can see the sharp spikes in unemployment of 2020 when Minnesota's unemployment rate reached 11.3%. As of October of 21, the state's unemployment rate had fallen to 3.5%. As of December, it's 3.1%. That's 0.8 percentage points below the US, and it's 12th lowest among states. The overall unemployment rate does not capture the full labor market story. In particular, it does not reflect Minnesotans who have left the labor force, including retirements or those staying home to care for children. Since the onset of the pandemic, Minnesota's labor force has fallen by 84,000. As of October of 21, Minnesota's labor force participation rate was 67.8%. That's 2.4 percentage points lower than in February of 2020. However, the relationship, even though Minnesota's labor force participation rate did fall during the pandemic, the relationship between Minnesota's labor force participation rate and the US labor force participation rate has remained robust. The state's participation rate remains high relative to the US. So that's typically the case. Minnesota typically has one of the highest labor force participation rates among states. So it's high relative to the US. It's about 6.2% percentage points above the US, and it is the 5th highest among US states. So that's as of October, and the numbers are a bit different since then, but that relationship Minnesota to the US remains about the same. As with the US forecast, we expect low unemployment and a high demand for workers in Minnesota to drive up total wage and salary income in the state. The next chart is another view of the labor market in Minnesota. This line chart shows total employment in Minnesota. It's the total number of workers in jobs in the state, and it's not a growth rate, it is the number of workers in jobs. We're showing only a small part of this. We're showing data since the last recession, so the recovery period since the last recession. We're just showing the top of the chart, so it kind of looks like we lost all of the jobs, but we didn't. This is just the top of the total employment chart. So it illustrates the state's steady job growth since the last recession, because you can see that even though there's some variation in that line as we go from 2008 to 2020, it is a pretty steady upward slope. And then you can also note that as we get close to 2020, that slope starts to bend. It starts to get a lower slope. That means that our employment growth was beginning to slow. The rate of growth was beginning to slow even before the pandemic. So that was largely because of slower labor force growth, which was also largely due to demographic change, the aging of the population. So we were starting to slow those gains when the recession hit, or when the pandemic hit. In March and April of 2020, as the pandemic was taking hold, Minnesota lost 416,000 jobs, approximately 14% of February 2020 employment. Since then, state employers have added jobs in most months. Through October of 21, 296,000 of the jobs originally lost had been recovered. Minnesota employment as of the November forecast was 121,000, or 4% lower than in February of 20, so the pre-pandemic level. Turning now to the revenue forecast. The first two columns of this table show actual receipts at the close of the prior biennium and the change from the prior estimate. The next two columns show the current forecast and the forecast change for fiscal years 22 and 23. I mentioned that income, consumer spending, corporate profits all grew more in calendar year 21 than had been expected in calendar year 20 and 21. This drove extraordinary revenue growth in fiscal year 21, which ended with revenues $2.775 billion ahead of our previous February forecast. This is the bulk of that $3.1 billion carryover from the last biennium to the current one that Commissioner Showalter mentioned. Moving to the second two columns, higher tax receipts to date in fiscal year 22, so as of the November forecast, not only had we closed fiscal year 21 well ahead of our February of 21 forecast, but we also had collected more receipts during the first few months of fiscal year 22 than we had forecast in February of 21. So the higher tax receipts to date in fiscal year 22 and that improved outlook for income, consumer spending, and profits brings the revenue forecast for the current biennium, fiscal years 22 and 23. Total general fund revenues for the current biennium are now forecast to be $5.13 billion more than the February of 21 forecast. We have raised the forecast for all major tax types. Individual income tax receipts are now forecast to be $2.708 billion more than the prior forecast. A higher estimate for tax liability in 20, which is the base year of this forecast, and higher growth in wage and non-wage income, especially business income and capital gains realizations. Those things together raise the income tax forecast for the remainder of FY 22 and 23. So let me back up a second there and reiterate that the base year for the individual income tax forecast was tax year 20. And we know because fiscal year 21 revenue was so much higher than expected that our estimate of tax year 20 liability had been too low. And so we raised that estimate. Sales tax revenue is now forecast to be $821 million more than the prior forecast. The higher forecast is consistent with that increased growth in consumer spending I mentioned earlier, and it's also due to higher collections so far in the fiscal year 22. The forecast is reduced by $359 million for elimination of the June general sales tax acceleration. The corporate tax is projected to generate $1.249 billion more than the prior estimate based on the higher forecast for corporate profits I mentioned earlier and higher collections so far in fiscal year 22. Now, we've released a revenue report since we released the forecast, and as of our January revenue report, which reports receipts for November and December, those receipts are now estimated to be $833 million more than forecast in this forecast you're looking at now, in the November forecast. However, it's really important to note that a substantial portion of December collections, and we expect this will be true for the January collections too, but we haven't reported on those yet. A substantial portion of December collections are pass-through entity tax estimated payments that were made toward the end of 21 that will be credited against business owners' individual income tax liability for tax year 21. That will lower income tax final payments and raise refunds in calendar year 22. We estimate that about $471 million of that overall $833 million variance arises from that timing shift. It's a timing shift between periods. So finally, let me reiterate some of the risks to this forecast. I mentioned that the forecast depends on the path of the pandemic, including, as I said, the November forecast didn't know anything about the Omicron variant. But the impacts of Omicron, but then any other new variants or treatments. The assumption embedded in this forecast that inflation settles back into the 2% range depends on the resolution of supply chain blockages and on an increase in labor force participation. Now, as I said, in January, IHS has lowered their expectations for labor force participation. Higher or more persistent inflation could change the timing of expected actions by the Federal Reserve. Supply chain disruptions and the pandemic path both threaten growth in other countries. Slower than forecast economic growth in important U.S. trading partners can lower demand for U.S. goods and result in lower than projected U.S. growth. And I would add that geopolitical risks that have arisen since the November forecast add risks currently. And finally, with 19 months remaining until the end of 22-23, even small changes in assumed rates of growth in important revenue sources can have big changes in the budget outlook for this biennium and the next. Well, now I'll turn it over to State Budget Director Anna Mingi.
Thanks, Dr. Kolumbakides.
Please introduce yourself for the record, please. Welcome.
Yep. Good morning, Chair Nelson. I'm Anna Mingi, State Budget Director at Minnesota Management and Budget. And I'm here today to talk about changes in the November forecast on the expenditure side of the state budget. The slide in front of you outlines changes in general fund spending in the recently closed biennium, as well as changes in the current biennium. As you heard from the commissioner at the start of the presentation, the changes we saw in fiscal year 2021 were meaningful because balance that carried forward into 2022, contributing to the projected surplus. Overall, spending changes are relatively small, about 0.7% lower in both the previous biennium and the current. So I'm going to start by discussing the changes in the 2020-21 biennium, which are the columns sort of in the middle of the chart. The first line, E12 education, is the largest portion of the general fund budget, was $84 million lower than projected as a result of fewer than expected pupils. The next line, health and human services spending, was $102 million below previous estimates, largely the result of underspending in agency operating and grant appropriations. Spending for property tax aids and credits was $80 million lower than previous estimates. And much of this is a result of reallocating general fund spending on business relief grants to federal coronavirus relief funds. As this committee knows, Minnesota has committed significant general fund resources to respond to COVID-19. And although we made those investments quickly, we did so with a mindful eye to fiscal responsibility. So as funding has become available through the federal government, MMB has looked for opportunities to reallocate previous expenditures to those federal resources, which provides relief to the general fund. And we're seeing that on the property tax aids and credits line on this forecast, as we've reallocated previously general fund business relief grants to the coronavirus relief fund. The next line, or the bottom line, all other areas of the state budget combined had $65 million in lower spending compared to end of session estimates. But much of this was underspending in areas that carried forward into 2022.
Dr. Mingy, before you leave that slide, do you have an idea why the E12 spending was significantly less in 2022 and 23? I know you alluded, we pay on a per pupil basis, so you alluded to less pupils. I don't know if you have this information or if maybe our education staff does, but how many fewer pupils are receiving public education expected in 22, 23, and how much of that is due to the declining birth rate as opposed to other choices that parents are making for their children, for their students?
Chair Nelson, that's a great question, and we have that data. There are sort of a couple trends going on, and they're different in the first biennium in this 2021 than they are in 22, 23, and so I can talk about them sort of distinctly. In 2021, the lower pupils, there were about 7.9 thousand fewer pupil units than end of session estimates. That's a 0.9% reduction. That is, I think, largely a result of some, COVID-related attendance choices. But in the next biennium, 22-23, the reduction, it's about 7.9 thousand in 2022 and 10.8 in 2023. And those are a result of two different dynamics. The first is that this forecast incorporates new base data. So meaning that we are using the 2020 enrollment experience to inform the growth rate in our E12 pupils. And in 2020, the state experienced much slower growth than in previous years. So for example, from 2013 to 2019, pupils grew by an average of 0.8% per year. But from 2019 to 2020, pupils grew by 0.2%. And the model for future growth is really informed by that average of recent years. And so that 0.2% really brings down our projections of future growth. And that's because it's based on 2020, where the enrollment experience wasn't really impacted by COVID. We think that that is just a more result of population change and changes in birth rate rather than impacts of COVID. Does that answer your question?
Yeah, thank you so much. I didn't mean to take so much of your time for that, but yeah, I do still have a question, which we'll get to, at a different point, which is really looking at how the declining birth rate is affecting these numbers, which I believe is continuing to decline. So even 2020 might not be the accurate number, but that's something for another day. But I just wanted to note that we've seen a big change in the number of pupils that are in our K-12 system, and I think it's important for us to know what that is a factor of, and that we plan, and I know the forecast will take all that into consideration. So, please continue with your presentation, however.
Thanks, Madam Chair. I think the declining birth rate is definitely a factor in that E12 forecast, and we have we regularly include in the forecast book sort of our pupil projections in future years, and you can see the impact of that demographic change in our education spending. So that I sort of walked through, moving on to the 22-23, I just walked through the drivers of that big change in E12 education, the $326 million reduction from previous estimates. So I'll move on to Health and Human Services, which was $94 million lower than end of session estimates. And a large driver of that change was lower enrollment in the state's child care assistance program, which was as a result of some COVID specific impacts. State spending on property tax aids and credits is also lower in the 22-23 biennium as a result of lower projected spending for renters' property tax refunds. On the next line, debt service payments are also below previous projections due to lower bond rates in our September 2021 bond sale and some updated cash flow estimates about the needs for bonding on existing authorized projects. The last line, all other areas of the state budget are $136 million above previous estimates. This is largely due to appropriations that were carried forward from the previous biennium and are reflected as being spent in fiscal year 2022. But this spending increase also reflects a $30 million contingent appropriation to the disaster contingency account, which was triggered by a positive variance in the general fund closing balance. So we can move on to the next slide to discuss changes in the general fund budget reserve. This slide illustrates growth in our general fund budget reserve in recent years, highlighting the changes in this forecast, which are the light blue bars. With this forecast, our current budget reserve balance is $2.656 billion in 2022. As a result of our improved general fund balance, the November forecast allocated additional funds to the general fund budget reserve, reaching the statutory target established under Minnesota's nation-leading budget reserve policy. Since 2014, Minnesota has had a budget reserve target, which is based on an annual analysis of revenue volatility, and our state law directs that 33% of the November forecast balance is deposited in the reserve until that target is met. Our current target is 4.8% of general fund revenues in the current biennium. As you can see on the chart, if you look at the dark blue bars, at the end of session, we projected a decline in the general fund budget reserve from 2021 to 2022. This is a result of two provisions enacted by the 2019 legislature, which resulted in $591 million moving from the reserve into the general fund. However, the 2021 legislature directed that the first dollar of any future forecast surplus go back to the budget reserve until it returned to 2.377. And so as a result of the November forecast, not only are we restoring the reserve to that 2.377, we are also depositing another $279 million, which is the amount necessary to meet the budget reserve target. So in total, we're adding $870 million to the general fund budget reserve in 2022. And with that increase, we achieved the target set in law. So I will turn it back to Commissioner Showalter.
Commissioner Showalter.
Oops, I keep on turning my camera on and off. Thank you, Madam Chair. The last slide here just walks through the long-term outlook. What you know is that we take a 4-year horizon about our spending and revenue picture to make sure that we have sustainability in view for legislators and the governor as we think about how our revenues and spending match up. In this forecast, we anticipate that revenue growth into the 24 and 25 biennium on an annualized growth rate will exceed the projected spending growth. And so that we have a picture of a structural budget, not only in the 22 and 23 biennium, but also in the 24 and 25 biennium. You also know, that we've talked about this regularly in our projections, is that the revenue forecast does include the effects of inflation on the cost of goods and services and the taxable base. And so there is a factor of inflation in those revenue numbers. There isn't in the projected spending. We basically take the latest appropriated budget and carry that forward only to the extent that current law makes changes in the education forecast, in parts of health and human services, and some other smaller factors. The result of that estimated inflation is about $1.165 billion. So even as we're all wondering what's happening with inflation, as Dr. Kolumbakidis mentioned, inflation is one of those questions that we're all wondering about. Know that the projected spending figures here do not include those that estimated inflation in 24 and 25. But all in all, it is certainly good news. This is a set of problems we're happy to ponder and work through. To wrap it up, Madam Chair, members, I appreciate the chance to testify before you today. This has been a remarkable set of circumstances. We appreciate all of the work that the team at MMB, state agencies, and particularly across the state have done to both put together these numbers and ultimately create these numbers as we keep on building back from the pandemic effects and find new ways of getting work done. So with that, Madam Chair, happy to take questions on the forecast.
Thank you, Commissioner. I have, what is that estimated inflation amount, 1.165 billion, based upon what inflation is baked into that number, and how does that compare to our current 40-year high inflationary rates?
Madam Chair, I'm going to ask Anna Mengi to go a little bit further. We do base this upon the inflation rates that are inside the forecast, so based upon our economic numbers. It is also a fairly simple estimate. I would ask the State Budget Director to walk through exactly what that covers.
Thank you. Budget Director Mengi.
Thank you, Chair Nelson. The inflation estimate is calculated by applying projected CPI, growth, which is at the time of the November forecast was 2.2% in 2024 and 2.2% in 2025. And we apply that to portions of the budget that don't include inflationary adjustments. And so there are a few pieces that we pull out, things like nursing home payments, which have a price-based rate adjustment, property tax refunds, and special ed are a few examples of things that we pull out before applying that growth. And then there are parts of the budget where it doesn't make sense to apply inflation, like debt service, but it's applying the 2.2% in those future years to 2024-25 spending. And I don't have a sense of how that compares to historic averages, although Dr. Kolumbakidis might have a sense.
Thank you very much, Director Mengi. And yes, and so the inflation number has pulled out those items of our budget that are automatically have an inflation factor factored in. I do see a couple questions from members. The first question I see is from Senator Rest. Senator Rest.
Thank you, Madam Chair, and thank you for the presenters. I would like a whole lot more discussion of inflation and how that is going to have an impact on budget decisions that we make at this time. I was very taken by an op-ed newsletter, whatever you want to call it, by Paul Krugman about expectations of consumers about how long inflation is going to last and at what levels it's going to get, and distinguishing between economic data that we get and monetary policy, which comes is not simultaneous, comes later, and how and what kind of expectations do you have of the Fed and their interest rates that they are going to be that they're indicating that they are going to be raising, and how does those two things together, economic data and monetary policy, that he discusses in that op-ed, how does that keep us from a recession? And in his article, he compared what happened in the late 1970s when we not only had inflation, but he indicates that people at the time thought it was going to go on, and that and it maybe even increase. And interest rates for consumers, mortgages, they got to be 10, 11, 12%. And that one of the differences that he sees between the 70s policies related to inflation and what's happening now is that consumers don't believe inflation is going to continue at a high rate. So there's more optimism, and that we can keep, and because of that, because we don't just see prices going up and wages going up, and of course in the 70s prices went up and wages not so much, particularly with regard to we had high unemployment, and we still had prices increasing. And I note that you listed inflation second to concerns for the pandemic. And do you anticipate that consumers, Minnesotans, whoever, that you're looking at for and that they look at for the February forecast, are they going to, do you anticipate fears for continuing increase in inflation, and rather than decreasing, how much of a factor you think that's going to play so that we do not get trapped through policies that we make going forward over the next few years to keep us solvent?
Thank you, Senator Rest.
I appreciate an answer to that.
Yes, a very good question. I think all of us are concerned about staggering inflationary rates and how it affects all things.
But they're not there yet, Senator Nelson.
Well, we think they're coming. Dr. Kolombakidis, though, how is your crystal ball? How can you answer that question today?
Yeah, well, obviously, as I said in my comments, inflation has become the salient, a more salient factor in the November forecast, and then it's going to be, not to foreshadow the February forecast, but inflation may well continue to be a risk in the February forecast. So the Fed has signaled that their intention to raise interest rates, and they've signaled their intention to taper their extraordinary asset purchases. And they have also made clear that all of these decisions are going to be data driven. And so as the economic data come in, and the Fed's got more than I have, but they are going to make these decisions based on data. And the Fed has their dual mandate of full employment and low inflation. And so that's what they're trying to balance, is they're trying to keep the economy from overheating, which causes inflation, at the same time that they're trying to get high employment or low unemployment. The risk is when you have structural factors that are causing inflation, meaning those are persistent factors causing inflation, that it will continue and you'll get a wage price spiral. If the factors that are causing inflation are more temporary, or there are solutions to them, then you might avoid that wage price spiral and inflation will remain subdued. What IHS is assuming is that some of the factors affecting inflation right now are temporary, including some of these supply chain disruptions. They have been, so through November, they were expecting increases in labor force participation to sort of hold the reins on inflation. They've tempered that, because as I've said, they have a lower expectation of labor force participation going forward. And so their inflation expectations are higher than they were in November. Regarding expectations, consumer and business expectations of inflation, it does appear that expectations are anchored at around the target inflation rate for the Fed. So that means that people, businesses, investors think the Fed can do this, can alter monetary policy and turn the levers of monetary policy in order to achieve their target rates of inflation. Now, in our forecast, we get down to the low 2% growth rate in CPI, but not until after this year. So we had higher than expected inflation last year. That's already happened. So in the November forecast, IHS was expecting 4.5%. And in their January forecast, they've got it at, where's that chart? 4.7%. And for 22, in the November forecast, they had their inflation expectation at 3.3%. They have raised it for this year to 4.2%. So this front loading of inflation, this is already happening in the outlook. What does that mean for budget planning purposes? As Budget Director Mingy pointed out, in the place where we put the chart where we put inflation and an estimate of inflation, that's in those planning estimates. So for the current biennium, what higher than expected prices does is it puts price pressure on the current budget.
Thank you, Dr. Cole-Makitas. Just one follow-up on that. Where has the unprecedented amount of federal spending and money sent to states like Minnesota, for example, according to Federal Funds Information Services, $65 billion of federal COVID relief funds have been sent to our state. And how is that factored into these inflationary numbers? And one would hope that that type of massive federal spending, likely spending our grandchildren's future, is temporary. We're not going to see that ongoing. And how does that impact the inflationary estimates that you are looking at going forward, particularly in our next budget forecast? If you can inkle a little bit about what may be coming there.
Yeah. So, Madam Chair, members of the committee, the large amounts of fiscal stimulus that the federal government engaged in 2020 and 2021 boosted economic growth in 2020 and 2021. So boosted consumer spending and supported consumer spending. And that helped the US economy continue to grow, and it helped the state economy continue to grow. People had money in their pockets and were able to spend it. And employers had loans and grants that allowed them to keep people on the payroll. All of those things supported economic growth. I don't think we know of the 4.7% inflation that we now think we saw in 21, what the source of all of that was. I don't have an answer for that, for what it would have been in the absence of that federal spending. But economic growth surely would have been lower. The spending that the federal government did, the stimulus spending, was deficit financed. So that meant that it could be pure stimulus because it wasn't paid for. That means that it increased the debt without having, it increased the federal debt, and eventually somewhere down the line, that's going to have to be paid for. And so there will be, of the total amount of debt, not just from this spending, but from the corporate tax cuts and all the other kinds of spending that were done in the past, the federal debt eventually has an impact on US economic growth. But I think that we have seen that impact be pushed off into the future. It hasn't had the negative impact in the near term that maybe 20 years ago or 30 years ago economists might have expected.
I thank you, Dr. Kolomoukidis. That is the concern, is that reckoning that's coming. Next, I saw Senator Klein. Senator Klein.
Thank you, Chair Nelson and Commissioner Showalter. I have a question, I believe, for Dr. Kolomoukidis or Ms. Mingy regarding the spending forecast and specifically the sub-item about health and human services, where there was a decrease in projected costs, and I think you attributed that mostly to decreased utilization of CCAP. What we're seeing in the medical world and everywhere, obviously, is this massive increase and sustained increase in healthcare utilization, both in the inpatient and hospital setting, but also in outpatient testing settings in the emergency room and so forth. And I just wonder, did that factor into your projections at all? Is that something you see having a fiscal impact for our public programs in the coming year? Or are we largely shielded from that impact by sort of our public programs, managed care contracts, et cetera? Thank you.
Dr. Kolomoukidis or Director Mingy, who would like to take that? Hop in, please.
Madam Chair, I can take that question. Senator, I would need to look at my, would need to work with the Department of Human Services to get you more specifics. In this forecast, I don't recall changes in healthcare utilization being a driver of change, but I think there's also a question of what's in the underlying forecast, and I don't have that handy for you. Certainly, the significant use of managed care for our basic healthcare services changes the timing of when the state budget would be impacted by increases of that nature. But we can connect with DHS and provide you a more thorough response.
Thank you. Ms. Mingy. Senator Weber, I see your hand is up.
Thank you, Madam Chair. And one of the question I have is a two-part question. The first part's, I think, fairly easy. The second part might require a little more discussion, but we all know that it's pretty well known anyway, that the Federal Reserve is probably going to raise interest rates in March at their next meeting. Number one, is there a maximum amount of increase that they can put on at one time? And number two, in light of the, I'll say, historically low interest rates that we've experienced in recent times, is there any thought as to how much of an increase would it take to actually slow the economy down, slow inflation down? Because I think we're somewhat in uncharted waters as to where we are from an interest rate standpoint.
Dr. Kolomoukidis.
Madam Chair, Senator, those are both very interesting questions to which I do not have an answer. I do not know if there's a maximum amount that they can raise the rates by. I'm just trying to think that through, why there would be a ceiling. I mean, I don't know that legally there would be a limit. I don't know the answer to that one. I can try to find it and get back to you. I think that the second half is how much would you need to control inflation?
Right.
I'm not hearing, the forecast is not, the forecasts that IHS has, which does account for controlling inflation into 23, 24, 25, doesn't have extraordinarily high rates. So they have it getting up to the annual average, the federal fund, this is just the federal funds rate, right? So this is not mortgage rates. This is the federal funds rate, the Fed's target policy rate. They have it getting up to 1.23% in 23. So in 22, they have it at 0.4, having been at 0.08 in 21. So those are the orders of magnitude we're talking about. So 0.4 on average over this year, 1.23 on average over 23. So it's a lot. It's 1.2 percentage points higher than what it was in 21, but still low relative to historical standards. And then in 24, they have it getting to 1.77, and that's about on average, and that's about where it plateaus. So higher than by quite a few basis points higher than what it was in 21, but low by historical standards.
Thank you. Members, I do not see any further questions. Oh, yes, Senator Weber.
Thank you, Madam Chair. I just want to comment that there probably the majority of the people, at least at the table here, you and I maybe can go back to when interest rates were different. The first two houses my wife and I bought were at rates of 10.25% and 12%. Now, obviously, the values were different in those days than they are today, but my children, who are at 40 or close to 40, they're just amazed at the kind of interest we paid in those days. So,
yes. Well, unfortunately, our first house was at 16%, and we never thought we would see interest rates under 10. So it is significant, these concerns about inflation, and we must not lose sight of that. So thank you for bringing up that piece of history that we'd just as soon forget. Members, any other comments or questions? I do want to thank the presenters. It was a lot of information to take in today. Some of us have gone through this particular forecast before, but it's important to see it again and hear it again in light of what we've seen with the staggering increases of inflation. I know we're all looking at it with different eyes today. We will, I know that we'll be looking forward to the next forecast, which will be coming soon. And so I just wanted to thank the presenters for for sharing this information with us, and just know that all of us, all Minnesotans really, are really watching and concerned about what's our future look like, what's the inflation going to do in eroding our hard-earned dollars, basically, and the future of our children and our grandchildren. So with that, members, I will just note that our next hearing will be Thursday, February 10th. And this meeting is now adjourned. Thank you so much.